morning. You're watching The Market right here in 80 now with me, Aisha Faridi, Nikunj Dalmia, Awan Dubash as well on the show. And it's not really the best of mornings, as was the case last afternoon as well. The fact that we sunk below that 17,200 print as well on the index and sharply lower than that, breaching some very, very key levels. And again, overnight, it's not been smooth at all. In fact, to say the least, it's been quite the roller coaster and quite the rough ride. Financial markets have seen huge and immense amount of volatility. You had the S&P 500 index settling in just marginally lower, but don't go by that. It was a wild swing from the high to the low of the day. The Nasdaq, even though on closing, has managed to eke out a gain for itself, but again, a huge volatility there as well intraday. And the rest of the market as well saw huge moves. Yields as well have plunged. In fact, the US two-year yield is down 47 basis points, and the 10-year yield has lost about 20 basis points, settling around that 3.5% mark. The US dollar index as well, that too has fallen about 0.6%. And the KWB regional bank index, that ended lower by about 7%, again seeing huge intraday swings coming in. So all that we thought could go wrong is actually going wrong.
Aisha, it's a patch of extreme price adjustment. Now, if there is panic in the market about something going wrong in the world, then equity markets by now would have really gone into a selling stampede. I guess every financial market needs to be looked at differently. So let's start with the big one first, which is the drop in yield. Drop in yield will only happen because of two factors. There is no other third factor I can think of. Factor number one, that interest rates have peaked out. If interest rates have peaked out, there are again two underlying factors here. That inflation has peaked out or the US economy is going to break down. That is the reason why yields have come down. I don't know which one is true. But for the moment, global financial markets, at least the US treasury market, are saying that we are nearing the peak of an interest rate hike. If we are nearing the peak of an interest rate hike, bond yields will come down. The fact that the dollar index, typically which goes higher when there is a issue in the world, is also down, it means that the currency market and the dollar index is indicating that the US economy will slow down and money is moving to gold. That also could be a function of the fact that a safe haven buying is making a comeback. So it's a very complex way in which how financial markets and each instrument has acted and reacted. You got a surge in Bitcoin, a surge in gold, a drop in bond yields, and a little bit of stability which has come in emerging markets like India and China. So just like one shoe does not fit all, you cannot connect all the dots in a very linear manner. But typically when you see this kind of an extreme volatility on both sides of the trade, and especially in the treasury market, it is bad news, it is not good news. The approach in this kind of a market is, if I may use the English word, don't be a cowboy. If I may use the Hindi word, which is a colloquial to Bombay, don't try to do something which is extraordinary different.
How's that Hindi?
Shivaji is the word. I didn't want to use it.
But anyway, let's just tell you what the Fed's response has been to the SVB fallout. And I'm just going to quickly, get the quote out here and tell you what the Fed commentary has been like, because they're saying right now that we are taking decisive decisions or actions to protect the US economy by strengthening public confidence in our banking system. This step, they say, will ensure that the US banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. So while Fed is, talking the talk, but clearly, investors out there are repricing assets all across. Like you said, the rise in Bitcoin, the move in the precious commodities, and the fall in volatility in equity.
Yeah. So in the light of what's happening in the world, I guess the CPI data, the US CPI data, and the Fed commentary in the Fed meeting next week is of immense importance. In general, the view now seems to be that Fed is not going to be increasing rates. That's a consensus view, and that's the reason why yields have come down. Similarly, will inflation come down in a measured manner? Well, the recent data seems to be telling us completely different. Now, the problem is that what if the CPI print is higher? And what if Fed is not very happy with the inflation print? Then that means they will not increase rates, that they will not cut rates, or they will not hit a pause button. If they don't hit a pause button, then what happens to the underlying ROI in the financial market? So it's not going to be an easy, patch, so to speak. Uh, if you have to connect India, see, I look at Indian markets differently, and you got to ask yourself that, okay, what has been the general price trend? The general price trend has been that up until now, Nifty has been in some kind of a range, and mid and small cap stocks were tossed around. While there has been a challenge in terms of dealing with volatility in 2023, given what's happened to the Adani stocks and global news flow, you've not seen a proper breakdown in the Nifty. But now you've seen what could be called as a proper technical breakdown in the Nifty. So what do you do in this market? That is the most important thing. Uh, let global cues take their course, because there is no point in trying to preempt and prejudge. You normally buy a patch of bad volatility when prices are very attractive, but I'm afraid they are not. I guess March would be a very difficult month to call, and I think for the market it will take some time to adjust, because Nifty is broken down, FIs are selling, it will take some time to adjust. Since markets are not very cheap, I think that closer to the earnings season, you will find some opportunity. But till that time, it's better to just watch the market, do your homework,
Stay on the sidelines.
stay on the sidelines. There is no
Wait for the
point in
dust to
yeah,
settle,
there's no
sort
point in, if you're a trader, look, the trend's broken. You go against the mob, which is the bears right now, you're going to get robbed. So don't go against the mob right now.
Don't go against the mob. And just to put that into context, yes, we did witness that acute sell-off in yesterday's trading session. That's how we wrapped up the day, 1.5% lower, and 3 straight days on the trot. But of course, yesterday the selling pressure intensified quite acutely. We were down over about 500 points in total, and yesterday shaved off about 258 odd points. FIIs, as we've been highlighting, they continue to remain net sellers to the tune of about 1,500 crores, for example, in yesterday's trading session. And then critical to monitor what's happening when it comes to banks. It's the Nifty Bank Index that tested the 200 daily moving average, and we're seeing a rout coming in banks across the globe as well, so we're not alone in this. The FII holding, incidentally, is at about 16% versus the average of about 25%. The F&O trend as well, indicating fresh shorts. And also we're monitoring what the global markets are throwing up. The fact that this morning you've got the US futures indicating a bit of a positive start, the SGX Nifty mildly in the green by about 1/3%, Nikunj. So even when we're going by way of levels to watch on the index, it seems that support around the 17,000, 16,800 mark is a bit critical.
Samir is ready. So let's connect with Samir and understand what he makes of this kind of a market madness. And Samir, good morning. Thank you for joining us.
Hello.
Everybody is trying to understand that what is happening in the world. Gold, Bitcoin, yield, just getting slightly non-linear, so to speak, isn't it?
But there's no need to understand everything other than to focus on the fact that broadly over time, equities will do well. And secondly, that broadly over time, if you buy on fear, which is not directly associated with you, you will mostly do better than other markets where their fear might be more valid up to a point. But I don't see the connection between US banking sector and our banks at the first level. And secondly, I was just hearing you say that if in the Federal Reserve meeting next week, the interest rate actually are hiked as told by Citibank or a few others, in some sense that would mean that the Federal Reserve thinks that the banking sector there is quite comfortable in a big picture sense, that they can handle even a few more blow-ups if it comes to that. But the point is that the Indian banks falling on the basis that some SVB bank there has had deposits going out looks a bit too wild to me.
About this entire global connect, which everybody seems to be talking about, which is that, okay, a banking crisis means that a repeat of 2008 could happen. Right now it is looking like a spark, but this spark will snowball into a fire.
Well, actually in 2008, it was very visible for 6-9 months before that. Although again, there we thought that India was not so much a part of it. But today, so even in the world, it doesn't look that bad. First of all, the response of the governments are much faster. The governments have broadly understood that instead of trying to bail out anything, you just give, even if it is extremely dilutive, capital to the financial system. take warrants, take penal interest rates, and basically if you give maybe maximum 500, $200 billion across the world as capital of these banks, whichever bank is doing badly, you can save the system. They have understood again and again. And therefore, there is no reason to feel that again they will take 2 years to react to that kind of an issue, where capital is an issue or flight is an issue. Now, of course, some other hedge funds might blow up this week because they might have been short these bonds, but even these bonds which have rallied are 2-year bonds, so I don't think anybody will blow up. But what I'm saying is every line, every twist cannot be viewed as 2008. 2008 itself happened after 70 odd years.
That Samir Ra's message to our viewers is that too much of analysis leads to paralysis. Don't do too much of
100%.
analysis.
100%.
Okay. Okay. Good news and good prices, they don't come together. Right now, news is not good. But our price is great.
Prices are not great, but they are not bad. First of all, look at it that when we are talking that this month is a big correction and whatever technicals you think have blown up, which I don't know what that means, but like the market is down less than 0.9%. If you look at it year to date, the market is down like 4-5%. And this is after absorbing a very big issue, which at the end has been handled well, which is from their point of view, the Adani issue, where people were feeling or would have felt if you had asked this question in November, December, that what happens if the Adani Group stocks fall 50%, what will be the repercussions, the side effects, the follow-on effects. Bull, nothing happened. So for us to be able to deal with the issue which may have come up later someday and absorb it in the same 2 months where FII flows were going out because people thought that they should go into China, that trade for them has failed. So I think in the end, India is doing quite well. Broadly, I'm a long short fund. I don't have that much to worry whether it is 70 net. I can reduce it to 50 net in 1 minute. But I feel that broadly it is not bad. Let's see.
Sure, Samir, I completely understand that the markets are being a little bit, foolhardy in this knee-jerk reaction that if an SVB is, falling down, why should we be selling Indian banks? But at a time when the FIIs are so away and aloof from India, and year to date we've been seeing the kind of, selling which has been taking place, and the sentiment largely is a little bit brittle, and the markets have been consolidating for a while. I guess at that time, these kind of news flow does not really augur well for us.
No, it doesn't. But I'm saying that we have been able to handle not just news flow, but actual events related to our market. The two actual events are the Adani issue, which has in the end been absorbed by the market. And second is the actual outflow in January, where the rest of the world was having inflows, where China was up some 10%, where US was up 7%. In that month, to have massive outflows was more depressing to me than being down 90 basis point in the month to date, where all these global issues are now affecting us. For us to have dealt with more specific India-related issues and being sort of highlighted in that sense in the month of January, overall is not bad. But obviously in the markets, like in anything else, nothing is straightforward. You have to only see big picture that, okay, sell, trim, whatever, but to think that, for example, let's look at IndusInd Bank, in which, by the way, we own shares. So now the Reserve Bank of India says 2-year tenure or whatever extension for the CEO. So what do the analysts or fund management guys go into a corner and think that, the RBI thinks that this CEO is not good, but doesn't matter. For 2 years, you have your run and do what you want. But, 3 years is a bit too much. I think this is like everything else in our system, that if we give 3 years, it would like that we are strong supporters of the bank or the individual, and 1 year will look bad. So, okay, move on in life. But why should that be interpreted that RBI had to give an A grade, A plus grade to nobody else has these grades been given? So over analysis, what I always believe, is a bit too much. You have to think, okay, somebody can tell me what would be the minutes of the meeting inside the RBI in a conceptual sense. When they decide it is just that, okay, move on. Let's decide all these things later. But to take it so literally that the RBI may say, okay, you can run this for 2 years, no problem, but 3 years is you'll do some unhealthy things. That's why I say over-analysis is too much and not needed every time.
Yeah, sometimes from the central bank's end as well. So, Sameer, what's the message for investors out there? Of course, for long-term investors, this perhaps could be a good opportunity to buy. But for the short-term guys, what did they do? Wait for the dust to settle down?
Well, short term also you have to define what is short term, but broadly speaking, I say it differently. I said what you do depends on what you have done. That means if your net is low, you can cover some shorts. If the net is high, you can let it be. If you are a new investor and who anyway doesn't even have 20% in equity, it should not matter. But broadly, I still believe that at the end of this year, the Indian market will be higher than it started the year with. A, for us, we will benefit a little bit from the currency, and B, whatever may happen now, definitely by third, fourth quarter, the interest rates in US will not be reduced, but the markets may start expecting that in the early quarter, next year, first quarter, the the rates will come down or whatever. Also, please look at it. If there is so much issue with the banks and people losing their jobs and VC guys losing their whatever and whatever is happening, it must be also a little bit disinflationary. It has to overall cast a little bit of a gloom on the US job scene and everything. So that itself might bring the inflation expectations down maybe 10 basis points, whatever number of basis points. So I think by the end of this year, you will, that is the US, start thinking that the market, that they can look forward to to cuts next year. And therefore, plus minus a few months from here, the world will move on. Unless you think that this is, as you said, the start of a 2008, I don't see that right now, because the tools have, you've learned how to use tools that are available to these governments.
Samir Arora, you've given us a reason to what we should really cheer about. Now my last but one question is very simple. If the world slows down, it will definitely have an impact on outward looking sectors, IT, to some extent pharma, metals. So the aggregate numbers surely will be weak. And if you're looking at the aggregate picture for the Nifty or the aggregate picture for the Indian market, that could be marked down. What happens in that scenario?
I agree. But I don't look at aggregate numbers, particularly the numbers coming from the commodity sector, because what happens is that if you look at the, say, 100 stocks, and if you take out 70, 75 stocks or 70 stocks, broadly they operate in more consistent, regular fashion in terms of growing their earnings 10 to 15%. So look at them. Consumer sector broadly grows in 10-15%. IT sector broadly grows in 12-15%. Private sector financials broadly grows in that range. What changes the estimates of the consolidated or of the index is that Tata Steel or Tata Motor will make $2 billion or lose $2 billion, and mostly lose $2 billion. And therefore, they just change the consolidated numbers of the market, but don't really bother 80% of the companies. And if you also look at it today, if you see that, Indian premium to emerging markets used to be 70%, it has now become 50%. If you see really what has happened is that the Chinese market, which was down, went up a little bit, and Indian relative premium to emerging markets became a bit more normal. It was so specific, so narrow to give it these big picture things that Indian premium is high and then suddenly Indian premium is in line just because the Chinese market went up and down. It's the same thing here. If a Tata Steel or any of these commodity companies' earnings get added, please note that these companies get very low multiples. Therefore, earning contribution from commodity companies should in any case make a lower impact on the index. Therefore, remove commodities. Now talk about IT. I don't like IT myself, so I agree with you on that.
But Sameer, in the event that the market would recover from here, which you do believe by year end, all the dust would settle down and India would be resilient and outperform perhaps the rest of the globe, what happens to banks? Because if the index has to recover and cover the losses, banks, because of their weightage, have to perform well. And I purely ask because, within banks, the performance of each and every cluster is just so bifurcated and divergent. What the HDFC twins are doing is completely different from what a Kotak has done, what the PSBs are doing, or what an ICICI Bank and an SBI together, or for that matter, IndusInd and Axis are doing.
We broadly like all of them. in some form or the other, except in PSB, we restrict our interest to State Bank of India. Relative to India, I think it is the best sector. And although it's not that I have bought yesterday or day before, but this fall looks a bit unreasonable, and it's just this the macro guys or the guys who manage money in 30 countries who really don't have time to individually look at stocks, but do it more as bets on either country or sectors, who at the first level will say that bank is doing badly, so I must sell. But little bit a connection, even I agree, happens at a sector level just by this commonality of investors across markets. But I still feel most confident of banks, then about consumer, and third about IT.
Just a view largely on the back of this SVB fallout. We're also seeing other asset classes, for instance, gold, cryptos surging. You've seen the dollar index as well being impacted. It's down now to about 103. What's your view on some of these other asset classes in light of what we've seen take place?
So other asset classes for me are that I'm beneficiary in terms of our fund. If the rupee strengthens, because our fund is India focused and exposed to the Indian rupee. But other things I'm doing, I don't do crypto. Gold I own myself, but that is not, I'm not doing it in a professional manner like I am a fund manager for equity, so I don't have much to add. But gold has in the end proven itself over the years, and it is worth it to have 10-15% in gold just as a buy and forget kind of a thing. I did this buy and forget in 2007 after the crisis, or 8. And it's lying somewhere in some physical form.
Okay. Won't probe on that, but good to get in your perspective nonetheless. Thanks very much, as always, Samir, for joining in. Time to connect with our chartists. Let's get in a little bit more laser focused on the levels to watch out for, given the kind of rout that we've witnessed 3 straight days on the trot. Naresh Mirani as well as Kunal Bothra both joining in. And Kunal, let's start off with you. Yesterday, after we broke that 17,000 or just about held on to the 17,150 mark on close, what's the indication now?
Good morning, Avan. So my sense over the last couple of days that the markets were getting into a rough kind of a patch. We managed to break below the 17,200 mark on the index. Not too much of built up in the open interest on the Nifty futures, but then the Bank Nifty futures indicate that there's been a significant amount of shorting which has happened yesterday. My sense is that today the market could be a bit two-paced, where you may see an initial bit of a bounce, probably to try and trim the risk from the portfolios. There could be slight bit of short covering, especially given the kind of shorts which were built up in Bank Nifty yesterday. And then probably in the second half, I would expect the markets to get into a corrective phase back again. So my sense is that till the time the Nifty doesn't close above the gap of 17,600, these minor bounces would eventually lead into a corrective phase back again.
Naresh, hi, morning. How are you viewing the fall sub that 17,200 level yesterday?
So yesterday's is the first tick below the recent lows of 17,300 roughly, which was holding on around the budget day again in the month of March start, and now we are below it. So first indications of a fresh down tick. And now what we are seeing is, as of now, if we don't break 16,800 to 17,000, that is what I expect to hold on. This could create a short-term bottom and a bounce from here on. And say the RSI went oversold in the previous downtick. As of now, it's showing a little bit of a positive divergence, unless it starts breaking 17,000 to 16,800 band. And the fact is, the index has gone nowhere. Say we are at the same prices where we were in August of 2021. So essentially, at these prices, one has to be more positive than negative. So the view is the index should find a support around 16,800 to 70,000 band. So you want to be a buyer closer to 17,000 rather than say taking a short here. Wait for those times, wait for a little more panic, or start buying on the way up once the recovery takes place above 7,500.
Okay, so remaining a buyer close to those 17,000 levels, that's the strategy according to Naresh. So let's find out then what individual stocks our chartists are picking out this Tuesday morning. And Kunal, what's emerging on your list?
So I'll go with one buy and one sell as of now, given the kind of mild bounce I'm expecting at least in the first half an hour or so. So the first one is a buy in Tech Mahindra, the stock which I've been bullish on earlier, has done reasonably well after yesterday's strong gap up opening. The stock has not filled the gap. It closed at 1130 plus mark, which is also a point which is above the medium term resistance for Tech Mahindra. So would suggest a buy with 1165 as a target, stop loss to be kept at 1110. And the second would be a sell on RBL Bank, showing signs of weakness, breaking below the key swing supports on the short term charts around this 150 mark. So at 147 approximately would suggest a sell, targets of 143, stop loss 150.
Okay, so that's a buy call and a sell recommendation. That's a strategy that Kunal is adopting. Is it a similar take on Anuresh that you have?
So continue to be defensive. So a buy and a sell today. So the first is a buy and power grid, a defensive stock which has slowly and steadily done well. Even in the last 2 weeks of the market volatility, the stock is actually up 5 to 10%. I expect this momentum to continue towards an all-time high. A stop loss at 220 and a target price of 250. Second is a sell on Eicher Motors, which has fresh breakdown after showing a lot of leadership over the last many months. First indication of a trend change out here for the stock. The leadership role which it had taken has gone. Started making a new bottom, a fresh lower top and a lower bottom formation. 3,100 was a mark which was holding on for the last 3-4 months. That has been taken out yesterday. Could see a correction towards 2750. The stop loss to be placed at 3,090.
Right. Okay, let's slip into a quick break. The SGX Nifty is indicating a mildly positive start, but let's not get fooled by that, or for that matter carried away, because that's exactly how it was yesterday as well. And then look what happened eventually. 17,236 is where the SGX is as of now, at least. So maybe a stable start at least is what you can pencil in. But let's take a break and let's hear out what CII President Sanjeev Bajaj had to say about, India's startup ecosystem, which he says is to enable its own financial ecosystem to support budding entrepreneurs.
Today, in economic terms, we are increasingly seeing a multipolar world. Yet, we need to confront many common crises that are impacting our growth. Multilateralism is in flux, and global institutions are functioning below expected levels. A combination of 750 million smartphone users, one of the lowest cost data networks in the world, coupled with 1.2 billion bank accounts and over 800 million unique digital IDs, has created a whole new digital opportunity which once again we can share with other countries. Third, with facilitative policies taking place, India is now the third largest startup ecosystem in the world, with over 100 unicorns and almost 100,000 registered startups. We believe that this entire culture on startups is one that drives entrepreneurism. It drives the basics of any society and economy.
Welcome back. Let's put the spotlight then on what Macquarie's Victor Schwetz is predicting when it comes to the Fed's rate tightening stance. He says that the Fed could perhaps moderate its message. Let's understand a little bit more. My colleague Pankaj joins in with all the details on that latest note. Pankaj, morning.
Well, good morning. When we just look at Victor Schwetz's note coming in this morning, it's talking about how global flows are panning out. And there are two things which people are worried about: what's happening in terms of quantitative easing, what's happening in terms of quantitative tightening. So from quantitative tightening to quantitative easing, there has been a repricing in the last few weeks, which has been on the extreme side across assets. And that is something which he believes investors should take a note of. But on the other hand, he's also saying that there is a fight between, what the monetary policy and the real economy is doing. They expect Fed, which will deliver its message post the meeting, something to moderate. Important data, the CPI and what happens to the US CPI is something which will be important. But more importantly, there is a battle between monetary and real economy, and how that settles down is something that they would wait for. However, they at Macquarie believe that inflation leak will get adjusted, and there is no artificial need of any demand destruction or any sort of slowdown which needs to be done. And that's why they believe that Fed will moderate on its own, and that will be led by the inflation data that comes in pretty soon.
All right, thanks very much. That's the latest coming in on the Macquarie node, talking about how the Fed could perhaps moderate its message down the line. From quantitative tightening to quantitative easing is the prediction. All right, let's focus in on our own markets and which are the stocks that are making the news. Let's start off then by focusing on JK Lakshmi Cement. You've got Antique, which has come out with their latest note on the key management takeaways. So what the outlook is on the sales mix, realizations, as well as the kind of financials that the company is targeting. We've got Vamakshi here to give us all those details. Morning, Vamakshi.
Well, absolutely. JK Lakshmi Cement's management is indicating that they're targeting to improve the EBITDA per ton by rupees 300 per ton to 1000 per ton over the next 18 to 24 months. Now, out of this 300 per ton improvement, they're expecting nearly 200 per ton improvement to come in by optimizing the geographical mix as well as increasing the trade or the premium product sale. The remaining rupees 100 per ton improvement is expected to come in from manufacturing as well as logistic and supply chain efficiencies. Now, with this, the company is aiming to be among the top 5 companies in terms of profitability. Apart from that, when we look at the channel checks, they're suggesting that in the northern region, which accounts for nearly 35% of the market mix for the company, price hikes have been seen around 3 to 4% on a quarter-on-quarter basis in the fourth quarter. Now, with that, the company is likely to operate at a near 100% utilization in quarter 4, which could actually result in Q4 EBITDA per ton surpassing rupees 900 per ton versus 646 per ton that we saw in the third quarter. Apart from that, they also believe that the benefit of lower fuel prices would start reflecting from the first quarter of next year. And this in turn would aid the company to narrow the EBITDA per ton gap versus the industry average. Now, the company has recently forayed into the putty business, and the management is also expecting strong growth to come in here with better profitability in this segment over the medium term. Now, what Antique believes is that the valuation post the stock price underperformance that we saw over the last 3 months seems quite attractive, and in fact they believe that this is a good entry point for investors to enter the company, which is why they've given a buy rating target price of 910 per share.
Right. Okay, Vamakshi, we'll leave it at that, and let's keep it with the management meets. And demand has remained strong across JLR, commercial vehicles, as well as passenger vehicle segments as well. Let me take it across to Ashesha to find out what the top takeaways from Tata Motors management meet were.
Absolutely. So Nomura met with the management of Tata Motors, and on the back of that, they've come out with this note. First up, they've spoken about demand, where they say demand continues to remain robust across all segments, be it JLR, commercial vehicle or passenger vehicle segment. However, they say demand has started coming off or softening in the passenger vehicle business, and this is due to dealer inventory increasing across all dealers. They've also spoken about JLR's order book, which continues to remain at a healthy pace. Apart from this, they've also spoken about macroeconomic environment and the impact of macroeconomic environment on the business, where they believe high interest rate environment has not impacted the business yet, and they have not seen any tangible impact on the order book as of now. However, they say they are seeing some kind of impact on the lower end models. Apart from this, they've also spoken about their volume guidance, where they say first quarter FY24 commercial vehicle volumes can be impacted due to pre-buying that we're seeing in fourth quarter of FY22. However, this is expected to stabilize from the second quarter of FY24. Nomura for now has maintained its buy rating on the stock with a target price of 508 rupees per share, and on the back of these commentaries that have come in from the management of Tata Motors, this particular counter will be in focus in today's trading session.
Much for giving us those latest details, Ashesha. That's what's coming in on Tata Motors. Moving right on then, let's hear it out from Neeraj Diwan of Quantum Securities. He's sharing his top fundamental stock ideas. Jindal Stainless and Vedanta is what he's bullish on.
Metals, as far as demand is concerned, is picking up. So there are some, initial moves that we saw in some metal names also. In fact, if you look at, besides ferrous metal, you see a non-ferrous or the stainless steel. Stainless steel anyway has been doing so well. If you look at the only company listed which is purely in stainless steel, as a Jindal Stainless, have been doing very well, and they're still seeing that demand is very strong. I think even the other non-ferrous names, whether it's Vedanta, so aluminum stocks, zinc, I think they also look very interesting. I think metals this year should do better than what they did last year. I think demand is picking up, and if the demand continues, because China opening up is also aiding to the demand. So if that continues, I think you will see a better performance this year than what we saw last year in metals.
Now, in case you've just tuned in, well, there are extreme volatility, extreme price adjustment. Gold, Bitcoin one side, bond yields one side. You got emerging markets flat, dollar index down, crude is getting crushed. So the world now seems to be divided. There is a school of thought which is that interest rates now will go lower rather than higher. There is a school of thought which seems to be indicating that this is not the end of the problem for the US banking sector, that's the tip of the iceberg, and that explains why gold has surged and why Bitcoin has just gone through the roof. But in general, if one looks at the past experience of how these crises have been handled, some would say that as of now the contagion effect is unlikely. So if the contagion effect is unlikely, that means sooner than later markets will stabilize. And if markets will stabilize sooner than later, you have to simply understand what it means for India. Without getting into too much of analysis as to what is happening in Bitcoin and what will happen to the US banking sector, what this means for Indian banks, what this means for Indian economy, and where prices now are going down because of fear and macro concerns, not because of logic and not because of a earnings downgrade. And I guess the India correlation is slightly far-fetched. So the sentiment, FI flows, technicals, yes, they will have underlying role. But will something go wrong to your fixed deposit in India? Will something go wrong to the Indian banking sector with what is happening? The answer to that is absolutely no. And if you are worried about your safety in Indian capital markets, your bank deposits, I think it's slightly far-fetched. Don't think like that. The two issues in India were the domino effect in the Adani stocks and what happened to Adani group of companies, and second, the way how other markets were outperforming India. And I guess both those concerns for the moment are getting addressed. So if you look at Adani group of stocks, Kunal, yesterday, Adani Green was in green, Adani Power I think was up, Adani Transmission was up, Adani Enterprises on a day like this was down by only 2%. So the real center of the storm, Adani group of stocks on a day like Monday actually outperformed.
Yeah, it actually outperformed, and even though I think for majority of the session, these stocks were actually trading up, most of these names. It was just, I think, in the last half an hour, last 1 hour, where the pace of the market sell-off sort of intensified is where you saw these stocks correcting. Now, there could be a couple of reasons which I would believe that, that could be one of the reasons why these stocks have been outperforming. One is because from the Jan highs for these stocks individually, major part of the shorting have already happened. And when there is an inherent weakness which is already there into stocks, where these stocks have fallen significantly below their previous 52-week highs, the extent of creating fresh shorts into these kind of names becomes a bit discouraging for traders, because then the risk reward is not in favor, even though you know that these stocks are significantly off from their previous highs. And the other way to look out for is that when these stocks have to get into a corrective phase, there has to be unwinding of long positions as well as creating fresh shorts. Even that is not happening into the stocks, or at least over the last couple of days of the data. And I think that's one of the reasons why you're not seeing any incremental sell-off. But still, I would believe that out of the most of the Adani pack, the likes of Adani Ports, Ambuja Cements to a larger extent, as well as possibly even Adani Enterprise, there could be stocks which could probably be trade-worthy rather than the rest of the Adani pack.
I was just looking at the percentage of stocks which are trading below their 200 DMAs on some of the key indexes. For Nifty, it's almost a 60% of stocks. For Nifty Bank, it's nearly 50%. For the Nifty 100, again, a 65%. For the mid-cap index, the Nifty mid-cap 150, that is, it's 55% of stocks which are below their 200 DMAs. And for the Nifty small cap 250, it's a solid 65% of names which are sub their 200 DMAs. Naresh, sectorally, what's looking like the weakest link in the market to you?
So sectorally, the weakest link has been autos in terms of, say, apart from Mahindra and Mahindra, the rest of the names, the two-wheeler auto pack has not been able to bounce back in a big way. So the Hero MotoCorps and Bajaj Auto, there has been no movement as such. Reliance Industries is something which has not been able to make a bounce back. Say 10% weight on the Nifty, and the stock has been struggling around that 2300 mark. So rather than extremely weakness, what we are seeing is stocks which are not doing anything and are the first to go back to the previous lows. And there are stocks which are holding on really well. So even after the whole correction, the HDFC Bank stock has not fallen a lot over the last 1 year. So it's Reliance, it's autos. Some of the banking names have not been able to make a strong bounce back. But overall, autos as a space has, even the leadership stocks have not been able to hold on. So finally, we've seen Mahindra and Mahindra also break down. Tata Motors has gone nowhere. TVS Motors has peaked. Eicher Motors is giving a breakdown. So I think auto as a pack has become a little weaker than what it was before.
Yeah. So if you could just give us a take then, Naresh, as to what the outlook is then on the critical levels that you're mapping out then on the Nifty Bank Index?
So Bank Nifty has been relatively better compared to the Nifty purely because it has not yet broken significantly the lows of the budget day. So the budget day low was around 39,400. Yesterday we made a bottom around 39,450 odd levels. Now that's an important price point because again in February we made a low around 39,500 to 600 levels. So this 39,400 mark has yet not been broken, which has been broken by say the Nifty by a margin of another 1% lower. So in terms of Bank Nifty, if we can hold on to 39,200, 400, that would be an indication that there is still strength left. If that breaks and sustains for a couple of sessions, then we have a possibility of going towards the 38,200 to 38,500 mark, very similar to the 16,800 to 17,000 mark for the Nifty. So for now, watching out for the 39,400 mark to hold.
Okay, while the SGX Nifty for now at least is stable, Asia markets are not. In fact, Hong Kong is now down a solid 2%, Shanghai is down 1.25%, Korea is down 2%. It's a 2% gash coming in for Nikkei as well, which equates to about over 500 points in the red. And then Australia as well, which is lower by about 1.6% as we speak right now. The SGX Nifty, it's indicating mildly positive start, but who knows? Let's see what turn it takes from there. For now, it's holding up 36 points up in the green as we speak right now. But, just yesterday we were chatting with Nilesha as well of Kotak AMC on whether the Silicon Valley Bank downfall, considering it's the biggest news that struck us since Friday, and how it's likely to impact India, if at all. And here's what he told us.
SVB was geographically concentrated bank in Silicon Valley, having very high concentration of bulk deposits. About 97.3% of their deposits were above 250,000, which is FDIC insurance limit. So it's geographically concentrated and sector concentrated bank. Their clients were mainly startups. They all got a lot of money when interest rates were low a couple of years back. SVP took deposits at attractive rates, and in order to earn carry of 40 basis points, they went and invested into mortgage-backed securities. This mortgage-backed securities were giving carry in the initial days, but as US interest rates moved up by almost 5%, there was a huge mark-to-market loss. Depositors who were smart recognized that SVB could be in trouble and started withdrawing the money. In order to fund those deposit outflows, SVB had to sell their portfolio and book losses. in order to recapitalize the bank, they announced a large equity offering of $2 billion plus, and that opened the floodgate. Everyone wanted to get out of the room because bulk of the deposits were uninsured. Finally, FDIC, which is equivalent of our DICGC, intervened and took the control of the bank. Over the weekend, Fed has come out with a Fed, the US Treasury, and FDIC has come out with a relief package. They have ensured that all deposit holders will be protected irrespective of whether they have insurance or not. The equity holders and bond holders of SVB will have to take losses. Another bank, Signature, which was also facing similar trouble like SVB, also has been taken care of. Essentially, Fed has ensured that this contagion doesn't spread. There's no flight to safety from lower rated banks, regional banks, to higher capitalized banks. Depositors' interests have been protected, panic has been prevented, and hopefully they'll now learn from SVB crisis and tighten the regulations. For example, stress testing for SVB was fairly low. There was no restriction on how much they could put into HTM like Reserve Bank of India has prescribed for Indian banks. So I'm sure Fed will take corrective action like they did in 2008 and ensure that SVB is not repeated again.
Nilesh, I also want you to use this platform to try and ease all the Indian investors, because over the weekend or on Friday night, when you had other banking names as well in the US fall, I mean, everything from a JP Morgan to a Wells Fargo to PacWest to First Republic, Citigroup, there was so much panic out there as to the contagion impact that SVB could have on even Indian banks, for instance. So just want you to address to the viewers right now as to how that has no correlation at all, and especially, the retail janta out there.
So essentially, our banking system is in a far better position. For example, SVB, out of their $200 billion balance sheet, could put $100 billion into HTM category. That's not permissible in India. Reserve Bank of India caps how much you can put into HTM category. Second thing, in SVB, deposit outflows moved very, very quickly. In India's case, our deposit base is widely distributed geographically as well as across various industries. And hence, this kind of deposit outflow is unlikely to occur. Third, in SVB's case, they were focused on bulk deposits. In our case, it is retail deposits. And more importantly, our regulators are far more proactive compared to SVB. If you remember, way back in 2008, there was a run on one private sector bank because one of the ATM went dry. It was a local event, not even a regional event, but yet RBI intervened to ensure that that bank remained open and kept on sending cash to repay all panicky depositors. People who were driven by panic and rumor mongering withdrew money, and then next day they all came back to deposit thanks to the immediate intervention at the local level. In SVB's case, we saw Fed had to take few days to intervene. So put all these things together, better regulation, quicker responses, much diversified this deposit base. I don't think so. SVB kind of things will happen in quote unquote regulated and supervised sector of finance in India. We do have our SVB equivalents in chit funds and nidhis and collective investment schemes. More than 1.8 crore Indians have lost close to 2 lakh crores over the last 20 years in variety of Ponzi schemes, whether it's EMU scheme, Tickwood scheme, plantation scheme. That segment, the unregulated, unsupervised segment of collective investment scheme, is SVB of India.
All right, we also interacted with Samir Arora, the fund manager and founder at Helios Capital, and he says that he sees no connection between the American banks falling and Indian banks seeing a ripple effect amid the ongoing SVB turmoil. Let's hear out his take out on the fallout and what it would mean for Indian markets.
Samir, good morning. Thank you for joining us.
Hello.
everybody is trying to understand that what is happening in the world. Gold, Bitcoin, yield, it's just getting slightly non-linear, so to speak, isn't it?
But there's no need to understand everything other than to focus on the fact that broadly over time, equities will do well. And secondly, that broadly over time, if you buy on fear, which is not directly associated with you will mostly do better than other markets where their fear might be more valid up to a point. But I don't see the connection between US banking sector and our banks at the first level. And secondly, I was just hearing you say that if in the Federal Reserve meeting next week, the interest rate actually are hiked as told by Citibank or a few others, in some sense that would mean that the Federal Reserve thinks that the banking sector there is quite comfortable in a big picture sense that they can handle even a few more blow-ups if it comes to that. But the point is that the Indian banks falling on the basis that some SVB bank there has had deposits going out looks a bit too wild to me.
About this entire global connect which everybody seems to be talking about, which is that okay, a banking crisis means that a repeat of 2008 could happen. Right now it is looking like a spark, but this spark will snowball into a fire.
Well, actually, in 2008, it was very visible for 6, 9 months before that. Although, again, there we thought that India was not so much a part of it. But today, so even in the world, it doesn't look that bad. First of all, the response of the governments are much faster. The governments have broadly understood that instead of trying to bail out anything, you just give, even if it is extremely dilutive, capital to the financial system, take warrants, take penal interest rates, and basically if you give maybe maximum 500 200 billion dollars across the world as capital of these banks, whichever bank is doing badly, you can save the system. They have understood it again and again, and therefore there is no reason to feel that again they will take 2 years to react to that kind of an issue where capital is an issue or flight is an issue. Now of course some other hedge funds might blow up this week because they might have been short these bonds, but even these bonds which have rallied are 2-year bonds, so I don't think anybody will blow up. But what I'm saying is every line, every twist cannot be viewed as 2008.
Okay, don't think this is 2008, not just yet. That's the messaging coming in from Sameer Arora right now. Just looking at what the SGX Nifty is indicating, it's still just about mildly positive as we speak right now, barely up in the green. Actually, it's picked up a little bit, 50 odd points now up in the green. But that's okay, let's see how the markets actually eventually close. That is what really matters from here. But yesterday, of course, it was a sharp fall. I mean, there's no way of sugarcoating yesterday's price action. 17,205 is where the Nifty futures shut shop and well sub that mark for the Nifty spot as well. Banks, they got clobbered. In fact, most sectors got clobbered. Everything from cement to real estate to autos, chemicals, they were all looking extremely bleak. Kunal, let's get in some fresh trading ideas from you. I recall yesterday towards closing, you said it's more of sell today, sell tomorrow. Is that the sentiment?
Well, yeah, I think broadly it is still, and I would not be too much perturbed about this 40-50 point gap up. I think on a net of adjustment basis, it's just about 20-30 points for the Nifty. More importantly, I think when we've broken some very important support levels for the indices, and when you see risk off across the globe, there's bound to be an additional pressure. So it's not as if that the 300 point cut or the 950 plus point cut on the bank Nifty would be bottomed immediately. There would be periodic bounces. We've seen that happening because the indices, they tend to get into oversold territory on multiple short-term time frames. So there's bound to be a mild bit of bounce into the index just as a relief for the indicators. But then that results into yet another leg of sell-off for the index. My only concern, for the markets as such, Aisha, is that there has been a risk-off which has started to happen across the globe, and you can probably look out for the correlation which is getting established when you see gold, silver, etc. They get into a rally phase. So that I believe is a clear indication that the equities across the globe are getting into risk-off, and at that point of time, it generally is an indication that there is more selling pressure for the index. So wouldn't be surprised that we managed to trickle some bit lower for the index maybe in the second half today as well.
Yeah, and you track the charts of both gold and silver as well pretty carefully, right, Kunal? Not just that, the VIX as well. So is that all indicating that perhaps there could be more downside for equity markets because you're seeing a rush towards safer haven and volatility indexes spiking up?
Absolutely, Aisha. So even yesterday, for example, the India VIX I think jumped by more than 25%, if percentage can be a good parameter for India VIX. More importantly, I think it's come back about the 16 mark for itself. Now, look at this, from the 2 weeks back of correction for the index, when I think the Nifty or the Bank Nifty corrected by some 1,000 odd points in a matter of 2 or 3 trading sessions. Even at that time, the India VIX had risen up to just I think 14 and a half odd levels. So yesterday was a new swing high for India VIX, and that generally is an indication that the markets are factoring in some heightened volatility. Now, when the markets are factoring in a heightened volatility, we can't expect that the markets could remain into a range for a prolonged period of time. And then even the global volatility index have started to shoot up higher. On one hand, for example, yesterday Dow Jones Industrials closed just 80-90 points negative, but then the Dow Jones Transportation Index, which is also a very important parameter, that index has closed sharply, I think 1.5% negative yesterday. So all of those parameters indicate that there could be more sell-off.
Right, okay. On that note, let's also get in some mid-cap trading ideas and figure out whether it's short bias when it comes to mid-cap strategies as well. Kunal?
So yeah, I'll suggest one more sell call. That's a sell on L&T Finance. The stock given a fresh breakdown yesterday, breaking below the 50-day moving average as well as the support of I think 89.5, 90 levels for L&T Finance. So sell, targets of 82, stop loss at 88.
Right. Naresh, what about your mid-cap ideas?
So we'll continue to stick with Balrampur Chini. The stock is setting up for that breakout of 410, 420. Over the last 3 sessions, good relative strength. A strong base made at 360 levels in the near term. A year and a half of correction done. So out here, good volumes were there in this uptick from 380 to 400. A zone of accumulation is 390 to 400. I expect it to go towards 450 plus levels in the short to medium term. Stop loss to be kept at 375.
Joins us now. Let's understand from him that what he makes of this madness in all asset classes. Peter, gold is up, Bitcoin is up. Aren't they supposed to be rivaling each other? Because gold was a hedge against inflation and Bitcoin was an alternate against gold. How come both of them are going up together?
Well, that's a very interesting question, and good morning. Oh, yes, good morning, Nikunj.
And by the way, India won the test race.
Well, yes, but yeah, I didn't want to mention that, and I'm a very proud Australian, and I'll be over there in a couple of weeks to see you in Mumbai, and I'll probably have to buy you a drink for that as a congratulations. But yes, it was good news for India. There's a lot of turmoil at the moment. I think bond yields got crashed overnight. Having a look at what the 2-year and the 10-year did, the 2-year was down 20% from just over 5 to just over 4%, Nikunj. And the US dollar index has come under pressure. Gold has had a massive rally to the upside, and Bitcoin is as volatile as ever. So, these are unusual times, and that creates unusual movements in markets. And let's just see how the next 24 to 48 hours develop, because I think this volatility will remain for a while yet.
So what do you think will fall first, Bitcoin or gold?
Well, I want to see what goes. Oh, that's a hard one. I mean, gold's had such a massive move to the upside. I saw it probably about 20 minutes ago, and it was running at about 19.15, and we're running at about 19.11, 19.12 at the moment. It seems to be strongly bid up, and I'm not going to suggest that you're going to see any reversal quickly. But put your mind back to Thursday. It was 18.10 or so, 18.15. I think Wednesday or Thursday, and it's had a strong move, nearly up 100. So there's that side of it, 5.5% up, but. Bitcoin, I mean, it's a wild bronco, and that just allows traders to really, I think, take on board big moves, and that's been demonstrated in the last 24 to 48 hours. Bitcoin's nearly 25,000. So yeah, I can't answer that one. All I know is volatility, and that's what traders want.
Do you see in the light of what is happening to the US financial market, commodity prices coming down? Because whatever is happening, the net outcome is that demand will be lower than what it was projected at the beginning of the year.
Yeah, to some extent, yes. Though I think when you're looking at base metals, I mean, they were really pushed down hard and they had a bit of a bounce, certainly after China reopened and up to that Lunar New Year period. So, from a demand picture, naturally, China wants to do a lot of internal demand, and what it's going to do as far as exporting. Exports need consumers, and consumers have been hit pretty hard globally. So it's be interesting, the export markets, a little bit like Japan, what they're going to export themselves out of this. And there's the first part. The second part is commodities are a lot cheaper than what they were. But it just depends on, there's so many factors at play. You've had underinvestment across the complex for many years, mining. So I know the demand picture's there going, I'm looking forward to seeing Mumbai in a couple of weeks and how aggressive they are as far as building and construction, and that all needs hard materials. So that's going on across the world. We'll just have to wait and see where the commodity complex plays in the short run.
Peter, I don't know how closely you track the dollar index, but the fact that it's seen quite a sharp fall, do you sense that this could be a trend change and we could see a further, dip?
Well, Aisha, we're at 103.87. It's certainly come under some big push to the downside since, this time last week, the 5-day. It's gone from, 105, nearly 106, all the way to 103.50. So, yeah, there's been big push down. And again, that's been the push up in gold. People have sold dollars, been big moves as far as currency trading. And it's hard to tell where that US dollar is going to go other than whipsawing. And, it may be back down to around about that 103.50 to 104.25 sort of bandwidth over the next day or so. But it's full of surprises at the moment, and no one knows what the next news story to drop is and what impact that has to the market.
Okay. So, Peter, if you have to initiate one trade based on what's happening in the world and what's happened to the cricket match, and where Indian team has qualified as the #1 team in the Test series, what would you buy and what would you sell?
I think if I'm looking at anything, I've got to be conscious as far as gold and maybe in silver. Silver had a big push up, so probably physical of those two metals at the moment for the fear and what, for the rest of 23. And as far as to the downside, I don't know. I don't want to say. I'm going to sit on that one because I think I won't be surprised to see the US dollar come under continued pressure. I want to see what that CPI number is tonight and how that drops. You'll get that at around about probably 5 o'clock your time, 5 p.m., 1700, that CPI number, and that'll tell me whether the Fed are going to be, how aggressive they're going to be at the next rate rise.
Right, Peter, good to have you on the show. We'll let you go on that one and we'll see you in Bombay.
I look forward to it, Aisha. Thank you. See you, Nikunj.
Okay. Let's just take stock of what the pre-open rates have kicked in at, and it's absolutely flat. In fact, we'll just give them a skip. You don't know where the markets are going to open and what's going to really happen from there. But Kunal, you did mention yesterday that we could see those false recoveries come in, right, after yesterday's big crash?
Yeah, there's bound to be because, so as I was alluding yesterday that after almost 20 days of data, there was first time where there was extensive shorting which has happened for Bank Nifty. Now, it's like, when all of them have become very confident that the Bank Nifty is going to get into a corrective phase, there are bound to be some intraday recoveries for the indices where these weaker shorts or the ones who have entered late into the system, they could be dished out. So, I think there could be a possible that we may see a 100, 200, even 250, 300 pointer rally for the Bank Nifty on an intraday basis. But then, once I believe that the market settles back into the trading, the risk has to get paired off from the portfolios, and that could invite more selling from long holders. So I believe that the markets could be two-paced today. Initially, you may see a bounce, say till 11:30, 12 approximately, where there could be some aversion of risk which could happen back again. And the second half, I believe that we could probably fall back into what the global cues are indicating as of now.
All right, there you have it. That's the overall indication coming in. But let's move right on then and run you through some of the other news and top headlines that we're tracking. And global pharma giant Pfizer has announced the acquisition of American biotech player Seagen in a $43 billion deal as the company looks at expanding its cancer portfolio. Together, the companies seek to accelerate next generation of cancer treatment, antibody drug technology, coupled with Pfizer's expertise and capabilities. Meantime, China's new premier has said that the key focus of the country's policymakers will be on growth, with special attention on the need for housing, income, education, and healthcare. Going forward, the focus will be shifted towards delivering a life of better quality, is what he's added for the people. Meantime, leaders from the US, UK and Australia have unveiled details from their next-generation nuclear power deal. Under this AUKUS deal, Australia is set to first receive the least 3 nuclear-powered submarines from the US. The allies will work together to create a new fleet using cutting-edge technology, and this pact is aimed at countering China's influence in the Indo-Pacific region.
And reports are suggesting that Kremlin is clearing Putin's schedule for a potential G20 visit for the Russian president. In fact, Putin has not left Russia since launching an offensive against Ukraine in February last year. A Russian spokesperson said that visit cannot be ruled out as Russia continues to participate fully in the G20 framework, but also added that no decision has been made yet. And the Supreme Court took up a batch of petitions seeking legalization of the same-sex marriages back home. The bench, led by Chief Justice, has decided to send the case to a larger constitutional bench. A 5-judge bench will be hearing the case on April 18. The centre holds the stance that cases such as these must be dealt in Parliament and not in the court. The top court has also agreed to live stream, in fact, the case as per the petitioner's demand.
All right, let's get a handle as to what our chartist's top index calls are this morning. It's critical given that we are looking at quite a bit of carnage that we've witnessed for 3 straight days on the trot. In particular, yesterday as we breached some very important levels on the downside. Sell on rallies, that's the view from Kunal. Nuresh says no trade, hold according to Kush Bora. What about the Nifty Bank Index as we're continuing to monitor levels there? It's the same call coming in, sell on rallies, no trade, and a hold call from our charters this morning.
You know what looked like a 60-70 point gap up start that's been sold into. So looks like we are going to be starting flat, and typically an index is going to be red. Now typically these are not the signs where you actually would say that you want to be a buyer. So this market now needs to be viewed very differently, at least in terms of the near-term approach. The near-term approach is that key technical levels are gone. There is extreme volatility in global financial markets. There is a price dislocation which is happening in the US bond market, Bitcoin, gold. So there are far too many moving parts. While you cannot connect everything and arrive at a linear conclusion, when you see this kind of a price gyration, you will always see it will create more harm than more good. Good news and good prices, I know, don't come together, but the problem is that right now, even though news is bad, the prices are not terribly good, and that I think is the missing link, where news has just started deteriorating at a macro level, at a global level. The price damage is not that attractive that it really warrants any kind of an contra buy. It's not like a 2013 sell-off or a 2022 sell-off which happened after the Ukraine war. It's day one of selling, at least for benchmark indices, and typically day one of selling is not something which gives you very strong entry points. That's how global markets are repricing assets. Sharp fall in global yields. Both crypto and bond markets, both crypto and gold have gone higher, and dollar index now is at 103.5. Kunal, 2 out of 3. You've got DXY, gold, and yield. These three factors are favoring in emerging markets. So sooner than later, you will see a bottom if these factors continue.
Well, we may see a bottom, but the point, Nikunj, is that when a sell-off gets into an extreme, when there is a risk-off which happens, the market gets into a zone where the supports, psychological levels, formidable supports, they get taken out. So look at an example like yesterday, for example, over the last 2 or 3 months, we've been holding on very, very tightly at that 17,200 mark. But then how easily the markets gave with that support. Bank Nifty managed to break below that 40,000 levels, break below the 200-day moving average for the first time in the last, I think, 8 or 9 months from July 2022. Now, when you see such kind of break for the markets, it just is an indication that there is a sharp adjustment towards risk which happens, and that adjustment takes at least a couple of weeks, if not more, for the markets to settle into. So my belief is that there could be some intraday gyrations on the upside, as you rightly said, dislocation from the different asset classes, but that also is an indication that the markets have not settled, and that settling phase, which I believe could probably take another couple of weeks.
Okay.
8 seconds and we'll get the first rates. The first rates are nothing exciting actually. If at all, you've got a little bit of drop, at least from the morning trade what we saw on SGX. First rates on your screen any second now. There you go, 16 points higher for the Nifty. The breadth is looking okay. It is not like a meaningful comeback in any of the major benchmark indices or any of the major large stocks. None of the banking stocks are bouncing back. If at all there is a print of more red than green, at least on my screen. Adani group of stocks are looking okay. Mid cap stocks are bouncing back, but it's not a market where you are seeing any kind of a relief or any kind of a contraction whatsoever. 15 points higher for the Nifty. Very feeble start for Bank Nifty. In terms of volume, Adani Enterprises today is down. Reliance is flat. Axis Bank is down. TCS is down. ICICI Bank is flat. Hardly any moves. Hardly any moves. Hardly any price action. Nothing whatsoever which is shining bright or is even collapsing.
Let's see what a couple of these stocks which are in focus this morning are up to. The fact that, crude prices also have fallen and Brent is now sub that $81 per barrel mark. Let's see what ONGC and Oil India are up to, because this is definitely not going to augur all that well for the sentiment. And then Mahindra CIE, wherein M&M sold 6.1% stake in the company at a price level of 357.39 via block deal. That stock has started off flat. Mahindra Logistics as well, wherein First Sentier Investors Fund sold about 1.74% stake. So that's another stock which is in focus. The crude fall is obviously going to perhaps augur well as a sentiment on the paint companies, which have a large component of their raw material cost as crude, but no, you're not seeing any such sentiment really. In fact, if nothing, we're in the red for Asian Paints, the largest of the lot. There's Tube Investment, which is forayed into contract development and manufacturing, 284.5 odd crore rupees investment. There's Lupin as well, wherein there has been no US FDA observations for their bio-research center in Pune. There's also Bharti. The entry-level tariff hike in remaining 3 circles as well has been undertaken. Bharti, at best, resilient and flat, I would say. Sona BLW, of course, after Blackstone exiting their entire stake yesterday. Today, there are reports indicating that some of the long-term investors have bought that Blackstone 20.5% stake in block deals. That stock starts off in the green. 419 is where that stock is right now. But besides that, yes, it's a very, very tempered start. Kunal, what direction are we likely to take?
So yeah, as I said, it could be a two-paced market today. Maybe the first half could be completely different than the second half. Depends on how the risk off happens for each individual portfolios. So I think most likely around this 11:30-12 is where we would probably get a handle that what's the range the markets are looking out for. Now in terms of the opening trade, which we had given a short as well as shorted Manappuram at close to 117 mark 2-3 days back. That's a stock which has come back towards 110 levels. So we're booking out of the shorts which were created on Manappuram.